大家好. What's up, everyone? So in the investing world, you may have heard of or been a part of the many debates on market timing and whether it is better to time the market or stay invested for the long term. Many believe that time in the market is always better than timing the market. For today's video, I will explore why time in the market beats timing the market and share with you 8 specific reasons. We will take a look at what some of these terms mean and discuss some of the top reasons why investors should focus on time in the market rather than trying to time the market. First off, welcome back to the Beasting Your Fire Journey channel. My name is Jordan, and in this channel I share me and my family's experiences pursuing FIRE, which stands for Financial Independence, Retire Early. Part of this goal is gaining dominion over our finances and sharing ways to increase financial literacy and improve financial health. If you find today's video helpful, please like this video, comment below, and share with a friend. We'd love for you to subscribe and join our Beasting Your Fire journey. Now, before jumping into these 8 reasons, I want to share more about market timing and what it means exactly. The term market timing is often used to describe the act of trying to predict future market movements. In other words, to buy or sell stocks at advantageous times. An investor might believe that a stock is due for a short-term price decline and sell the stock before the decline. Many individual investors and even some professional money managers believe that they can successfully time the market, but there is no clear evidence that this is possible for the long run. In fact, most investment experts recommend against attempting to time the market. What does time in the market mean then? Time in the market refers to the concept of staying invested for the long term. Even if there are short-term fluctuations in the market, do not panic. Investors should remain patient and not make any rash decisions. Many experts believe it's impossible to consistently time the market, and so let your investments ride out the ups and downs instead. Now, here are the 8 reasons you've been waiting for why time in the market beats timing the market. There are several reasons why market timing is so difficult. Each side of this debate has valid points, but ultimately, the long-term investor is more likely to come out ahead. Here are the 8 reasons why time in the market beats timing the market. Reason number 1, it's impossible to know exactly when the market will rise or fall. Even if you think you know, you don't know for sure. First off, it's very difficult to predict future market movements with any degree of accuracy. Even professional investors who spend their entire careers analyzing companies and markets have trouble consistently making correct predictions. Knowing where the market will go next is a very difficult task. Reason number 2, difficulty predicting the exact time. Let me explain. So even if you can correctly predict short-term market movements, you would still need to be right about timing your trades. The market can stay at a certain level for a long time before moving in the predicted direction. Reason number 3, losing out on a great position. If you sell stocks when the share price starts rising, you might not get back in at the same price. This is because once a stock starts rising, it can continue to do so for quite a long time. Reason number 4, commission fees. Another factor to consider is commission fees. Every time you buy or sell stocks, you will have to pay a small fee to your broker. If you are constantly buying and selling stocks, these fees can add up quickly. Commission fees can eat into your profits if you're not careful. Reason number 5, taxes. You will have to pay capital gains on your taxes if you sell stocks that have gone up in value. Here's the best part. By holding on to these stocks for more than 1 year, you'll be eligible for long-term capital gains tax rates. This long-term rate is lower than the short-term capital gains rate. Reason number 6, time in the market is stressful. Attempting to time the market can be a very stressful endeavor. Constantly monitoring your stocks and making decisions about when to buy or sell can take a toll on your mental and emotional health. The stock market is a very volatile place, and prices can change quickly. Reason number 7, too time-consuming. In addition to being stressful, market timing can also be very time-consuming. If you're trying to predict short-term market movements, you will need to spend a lot of time analyzing data and making calculations. You could be taken away from other important things in your life, such as work, family, increasing financial literacy, and building a business. Just whatever you do that brings value to your life. Even if you're not actively trading at the moment, traders that try to time the market still need to spend a lot of time following the market and researching stocks. Reason number 8, missing out on compound interest. I love this quote from Albert Einstein, which says, "Compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it." This quote rings true to me, and we have seen at our young age the power of compound interest and what it will do for us over the years to come. My wife and I have seen the power of compound interest by starting investing at a young age. Compound interest is when you earn interest on your investment, and then you also earn interest on the interest that you have earned. Your money will grow at a much faster rate than if you simply leave it in a savings account. If you're constantly trying to time the market, you will miss out on the opportunity to let your money grow through compound interest. You will be constantly moving your money in and out of stocks, which means that you will not have the chance to let your investments grow over the long term. For example, let's say that you invest $1,000 in a stock and it goes up by 10%. After 1 year, your investment would be worth $1,100, right? If you reinvested this money and the stock rose by 10% again, your investment would be worth $1,110 at the end of the second year. Now hear this. After 30 years, you would have $17,449.40. If you were to try and time the market, you would likely miss out on some of these gains. If you decided to only stay in the market for 15 years, not 30 years, you would have only made $4,177.25. This is also only if you pick the 15 years that the stock sustained a 10% average. You may be able to time the market a few times, but to do it consistently over multiple decades is highly improbable. The longer you stay in the market, the higher probability you continue to compound your investments into financial freedom. The more you trade, the higher probability that a mistake will occur that will lead to a large loss in both time and money. So it's important to remember that the stock market is a long-term game. Not to mention, if one of the most intelligent minds in history prefers time in the market over timing the market, it should be good enough for the regular person. So remember, there's no clear evidence that anyone can successfully time the market in the long run. Many investment experts recommend against attempting to time the market, and there are several reasons why time in the market beats timing the market. Some traders are successful, but about 80% of traders lose money, and that percentage goes up the longer you look back at timing the market. If you leave your money in an index fund that tracks the S&P 500, for example, you're likely to make more money than if you try to time the market. This is especially true when you let compounding happen and stay patient for decades. So there are many reasons why market timing is difficult, but ultimately the long-term investor is more likely to come out ahead. By staying invested in a diversified portfolio of index funds, you can weather the ups and downs of the market and be well on your way to reaching your financial goals. So what are your thoughts on timing the market versus time in the market? Drop a comment below and remember to subscribe for more financial freedom content to come.